For joining us this evening. Again, I'm Terry Allman, and we're going to talk a little bit today about the presidential election and investing and some topics that I found interesting as the year started to wear on, and did some investigation or some research, and hopefully you'll find this interesting. And let's take a look at the next slide. Here we go. The topics that I wanted to talk about today, and that research that I'd done sort of uncovered some interesting things. Can the stock market predict the election winner? Does the stock market prefer a particular political party? And then kind of roll into, what impact do the President and Congress and the Federal Reserve have on the economy in general? And just to give a little bit of background for this, what I ran into as I started to investigate this was, number one, I did not want to really be here preaching about who's better for the economy, one political party or the next. My main focus was, is there a way to make money? Is there a way to trade or invest on this particular theme? And as I went through that, I started to determine that a lot of individuals place a lot of emphasis on the presidential election and the economy. And what I found was that a lot of times I didn't think folks maybe assigned the proper impact that the president versus other groups might actually have on the economy. So I thought it'd just be interesting to focus a little bit on that towards the end of things. And as always is the case, we need to provide proper disclosures and disclaimers. So I'll give you an opportunity to read this one. And here's a little bit more. Okay. Number one, before we get started, who is OJM Group? And we are a registered investment advisory firm, but we're also more than that. We're a full-service financial consulting firm. So wealth management, that's the upper left-hand corner, that's the part of the organization that myself and my colleagues represent. We invest assets for individuals, but as a firm, we also provide retirement, institutional investing, insurance planning, tax advisory services, asset protection planning, etc. At the end of the presentation, you're going to have an opportunity to select some from the OJM materials that our partners and other individuals here have taken part in writing. There's a lot of great information. I recommend picking up some of these, and you'll have the opportunity to do so. As far as how we manage money, we take an institutional investment approach tailored to individual client needs. Primarily, what we do is utilize strategic asset allocation supplemented by opportunistic security selection during the portfolio construction part of the process. We really focus on non-correlated alternative investments. We feel in the current climate that is a critical factor in investing. Most of what we do is based on modern portfolio theory, and that is the asset allocation, diversification, and really trying to build portfolios that assist people in reaching their goals. We also have the support of an entire financial consulting team, as I mentioned earlier. So our clients have access to any tax, insurance, estate planning, or asset protection issues that may come up if they have assets that we're managing. We certainly allow them to and provide them access to other experts here at the firm. So the election and the markets. What we're going to do first, let's take an entry poll so I can kind of gauge folks and get an idea. How many of you think that the market can predict the election? Um, And, you know, number one, no, the stock market cannot predict the election, or no, there are other variables in addition to just the market, or yes, the stock market is a good predictor of the election. Okay, looks like the vast majority of folks selected no, there are other variables in addition. Sorry about that. Okay, interesting, and we're going to get to that very quickly. One thing I wanted to discuss, you know, we're focused on investing effects versus the economic effects of the market. But as I mentioned earlier, we get the question multiple times, it's an election year, how should I invest? And hearing that question really got me to wanting to find out if there's any truth to a lot of the folklore that is out there about the market. And some of that we're going to look at on the next page. But again, I'm not attempting to determine if one party or another is better for the economy. What I'm doing is looking for investable themes based on data. Common market election folklore. Number one, the market prefers Republicans to Democrats. I've heard that enough times, but occasionally you wonder, well, is there anything that backs that up? So I found a couple different studies that I'll reference in this. But another one is it's the economy's stupid. And I think James Carville was the individual who really got this popularized back in the 90s. But, you know, in general, the feeling is if the economy is doing well, an incumbent is virtually impossible to pull out of office. So we wanted to take a look at that. And a little bit overall, I guess, what we're trying to do is determine, hey, if it's possible to invest on the election, we need to be able to predict the outcome of the election with some kind of reliability and then place a trade based on that outcome. So the first question we need to answer is, can the election be predicted based on the economy or markets or anything else? And, you know, one of the interesting things that popped up, there are no shortage of prediction indicators. One I popped across here was a Halloween mask indicator. Spencer's Gifts, I think we've all bumped across that at the mall. They claim that over the last 4 elections, whichever candidate that they've sold the most masks has won the election. I didn't have an update here through the end of the week, but I think as of a month or so ago, President Obama was leading in mask sales. I've also seen recently that 7-Eleven, there's some kind of a cup indicator that they have. But the point being, everybody's got some kind of an indicator out there, but I wanted to determine if there was any market or economic-based indicators that really had any statistical validity. Paper I located called Social Mood, Stock Market Performance in Elections was really the best out of dozens I looked at from the standpoint of answering this question and actually doing the data research that was required for this. And there was no statistical evidence that GDP, our gross domestic product of the United States, or inflation or unemployment have predictive power in election cycles, which was, I was pretty stymied by that. I expected there would be some correlation, maybe not huge, but there was virtually none. But what was found to have a very high predictive power was the stock market performance for the prior 3-year period leading up to the election. The correlation was positive and significant to the incumbent's popular vote margin. So the better performance of the stock market for the 3 years prior to the election, the wider the margin of popular vote statistically has been the case. The stock market performance for the prior 1, 2, and 4-year periods is much weaker than the 3-year number, although it was still significant. It had some predictive capability there, but it just wasn't as strong as the 3-year. And there's a number of reasons you might posit that. Number one, most people give the president a free pass for a year, so that 4-year number isn't going to be as significant as the prior 3. Why 3 rather than 1 or 2? I don't know that I have a perfect answer for that, but most likely the individuals give the president, they want to look at the whole body of work for the most part. So a little deeper dive into this. I wanted to find out, how does that work exactly? And oddly enough, and this is extremely important, this is not via a wealth effect. They are able to parse out the data, and the way they looked at it, they determined that it's not a matter of the market, if it was up 50% and somebody with $100,000 after that 3-year period had $150,000, they did not look back and say, hey, I'm wealthier, I want to keep this person in office. It really acted as a proxy for social mood, which is fairly intuitive. The Dow Jones Industrial Average actually has a lot of very good qualities in assessing how the general mood of our society in America is leading up to elections. And what they found was this was specifically applied to the re-election of incumbents. It was interesting that even if the market had done well or done poorly, but specifically if it had done well, but the incumbent had actually used up his 2 terms, there was no carryover to that particular party's new candidate coming on board. The social mood that was in place, they did not assign to that individual. So I found that to be fascinating. But the bottom line is, when the social mood is optimistic, when people feel good about where they're at and how their lives are going, and feel good about the country, they tend to keep an incumbent in office. That's fairly straightforward. But I think this really creates somewhat of a dilemma in this election. If we're looking from an investment standpoint, do we want to make an investment based on these historical correlations? The question I have is, how is the social mood in 2012? For the period September 30th through 2009, the 3 years leading up to this election, the Dow Jones cumulative return is 49%. Well, that would, based on the evidence that we saw, that would forecast a victory for President Obama. But I think where we've got the most interesting part of this is, do we think the performance of the Dow Jones Industrial Action reflects the current social mood? And my feeling on this is, I don't believe it does. And that comes from speaking to clients and prospects and people in the markets on a daily basis for the last, multiple years. I've never quite seen a situation where we've had a great run in the market for the last 3 years, and people really are bombarded by negative news on a daily basis on the financial channels. I speak to clients who feel like their accounts are losing money, and I have to remind them, you're actually up for the year, and actually it's been a pretty good year in the market. And I guess my point is, I don't think that the stock market currently reflects social mood, because the market's up, and personally I believe the social mood is not reflective right now of that. So I sort of come back to, would I want to invest based on this? And my answer is no. I'd be uncomfortable putting my or client money into a investment strategy based on how the market's done the last 3 years. And currently, according to polls, we're in a bit of a dead heat. A few weeks ago, it looked like before the first debate, President Obama had a lead, not a gigantic lead, but it seemed to be pretty consistent, and it looked like it was going to be a no-brainer in my mind. Wow, it looks like it's going to happen again. given this, although I'm not comfortable investing on the past correlations here that we've seen, let's erase that for a second. Maybe look forward to maybe the next election, or there'll be a little bit of return to normalcy, and I'll feel more comfortable with that. So how would we do that transaction? And number one, we would need to decide, does the market prefer Republicans or Democrats, or does it matter? And then we could invest based on that. The incumbent, like today, is a Democrat, and we find out that the market doesn't like Democrats. We could go short the stock market, or we could buy puts on the S&P 500. There's a number of strategies, but we need to have a plan in place if we want to take advantage of that. I found another study that unfortunately was a little bit older, but I thought it really hit the nail on the head, and it was called The Market Prefers Republicans. And it was published in 1980, and it covered elections from 1900 to 1976. And it really studied price movements of the Dow Jones Industrial Average during a 17-week period around elections. So it kind of had, it was targeting the exact type of information I was looking for. And the data did show that the market reacted positively to Republican victories. So, and it was fairly significant. It really came to the 26 trading days prior to the election and 18 trading days after the election. For those years, the average return was just shy of 9% for a Republican victory. The market was positive. That's a very significant return in a 6-week time frame. Matter of fact, 9% is not a bad return for a whole year. This really caught my attention, and so I wanted to delve into it a little bit further. Is this statistically valid? Is this likely to continue? So, one question I had was why prior to the election, and I think that the market would tend to expect a victory based on polls, etc., and so it would start to pick up beforehand. But interesting data nonetheless. So the next question I had was, well, can we validate this a little bit? How would we take advantage of this opportunity? I came up, as the more I looked into it, I came up with some issues. Number one, the results after 1944 provided much lower returns. Only 3.8%. That's less than half of the overall time frame. Two issues with this, and the first is, well, currently we're after 1944. So that gives me a bit of pause. Second, in statistical parlance, if data taken out of the original set doesn't produce the same or similar type correlations and returns in different time periods, we say it's not robust, and that really gives me a lot of pause. If you can alter the time frame and get a lot of different percentage returns, it makes it very unpredictable. Also, the window to buy and to sell was very specific, and it was a little unclear from the data if you bought a week earlier or sold a week later, how that would impact your returns. So again, these start to mount and create issues around, well, is this really a way to play this theme in an investing time frame? The reason you would expect this to be the case is that data over large time frames really are based on different underlying economics and market situations. Back in the 70s, we were kind of in a malaise. If you go back to 1900, we had a Great Depression in there. Post World War II, we had a really nice uplift on things. So doing an average over that time frame of performance really started to seem like, even though there was significant data and it showed a statistical validity in this, I just personally wouldn't be comfortable trading on it. And in general, trading requires market timing, and virtually all market timing research that's been done, it's just shown that investors impair their returns as they attempt to market time. So not that I would never put on a trade. We will occasionally, especially if we see something like currently oil closed under $86 a barrel today. If that were to get down into the low 80s or the high 70s or continue to drop, we might look at that as an opportunity for the specific clients to go ahead and buy some ETFs or oil futures and do a play on that for somebody who wanted to be a little aggressive there. But by and large, this is more of a trading type investment strategy, and ours is more strategic rather than this tactical over time. Wanted to take a minute and just talk about trading versus investing, because trading is short-term buying and selling. You're looking to buy low and sell high. A lot of people, there are tons of traders out there. They trade everything from futures and actual stocks and bonds. Successful traders use self-imposed rules, and they're very active. And the key to this is they tend to follow trends. And if the trend shifts on them, they get out immediately. So they're very momentum driven. Trading, there's a lot of very successful traders. They can do very well for themselves. It is a full-time function. It generates very high transaction costs, and timing is everything. And the last couple of years, if anybody's heard the term risk on, risk off, it's been extremely difficult for traders to consistently be able to make money because the trends keep reversing every, gosh, it almost seems like every day. But what we try to do more often is invest. And by investing, we're basing our decisions on longer-term themes and the value of the investments. You know, in our minds, every investment out there has its own specific risks, and it also has a potential return that's based on the intrinsic value of the investments, which, not to get too technical, but it's really the expected future discounted cash flows of an investment. And that can be measured, and you can get an idea of whether something is fairly valued at a particular point in time. But when you're investing, due diligence is key. You need to investigate the particular investment, understand the overall environment you're in, and diversification and asset allocation are key. You want to diversify away specific individual risks of investments, and that's you know, one of the best things we can do in investing is diversify away what risks we can. There are transactions involved in longer-term investment themes, but they're typically, you want to select opportune entry and exit points as much as possible. Other transactions occur at predetermined rebalancing. Typically, annually, we'll go in, look at accounts, and rebalance them so that if one particular asset has outperformed for the year, we typically don't see continual outperformance. So to try to get away from that buying high and selling low, if we rebalance, we sort of clip off the gains from the assets that have done well, and we put more into the assets that may have lagged. And that, over time, has been a very good strategy in that different asset classes outperform over different periods of time. We got another poll up, so we'll take a look at this one. Who has the greater impact on the economy? You know, is it the president? Is it the Federal Reserve? Or is it my Aunt Millie? Okay, interesting. Looks like the vast majority has selected the Federal Reserve, and outstanding. And this feeds into a couple themes. Okay, and it got me to deciding it would probably be a good topic to just discuss who is running the economy anyway. And this sort of came about as I've heard, if once, I've heard at least 150 times that this election is all about the economy. And in my mind, I'm thinking, well, of course the president has some impact. Over the years, my belief on how much impact the president has on the economy has gone up and down a little bit. Having been an economics major way back in the day and having dealt in the field, the Federal Reserve and Greenspan for many years, and Chairman Bernanke for the last several years, they have such a visibility that the Federal Reserve as an institution has gone from a group that not many people really even understood what they did 25 years ago to a daily review, and every one of their meetings before Congress is now shown on CNBC, and all their meeting minutes internally are dissected. And with that, I thought it'd be good to just sort of draw some contrast between how the President and Congress impact the overall economy versus how the Federal Reserve impacts the economy. And this isn't information that probably anybody doesn't know, but I think it's interesting to really kind of focus on it for a minute. You know, we're about to elect a president, and we may have our incumbent, President Obama, retain the office, or we could have Mr. Romney, Governor Romney, take over. How would they be impacting the overall economy? And number one, they determine the U.S. budget, or they submit a budget proposal to Congress. House and Senate then have to pass that, and of course it goes into subcommittee and they hash it out, but it gets forwarded back to the President for his signature or veto, and then they might have to start it all up again. Well, this is extremely powerful. The budget determines all the government spending and revenue. And within that spending and revenue, yes, one of the large portions of our gross domestic product is government spending. It typically takes up about 23 to 29% of our GDP. And, you know, they can always request to spend more money, and certainly we're spending all kinds of it. But they can also elect to raise taxes, generate more revenue. Within that budget, they can try to incentivize different industries with tax breaks, et cetera. You know, certainly healthcare, energy, and defense are entire industries that the President and Congress have a dramatic impact on these through the budgetary process and what's allocated there, what's taxed there, et cetera. These decisions have a tremendous long-term impact on the direction of the economy. And I think over the last 20, 25 years, we've come to really view the Federal Reserve as having the most direct impact on the economy, and that may be the case in the short to medium term. But if you're looking at real potential growth in the overall economy, the historical factors that impact long-term GDP growth are population, accumulation of capital, increased productivity, that is innovation, and human capital, education. And these are things that within the budgetary process and through the President's initiatives and the things he gets behind, and Congress either gets behind or what have you, these are tremendously impactful to the economy. The Federal Reserve, on the other hand, they're an independent agency. They control the money supply, and that is also an extremely powerful tool. They set the base interest rate level. So if they want to stimulate more lending out there, they lower the interest rate level. And of course, we're at rock bottom interest rate levels, virtually zero, and we still don't see a lot of lending. And they can also go out and buy and sell bonds in the marketplace, which and they've been doing this function for many years, but not to the extent that they certainly have done it since the financial crisis of 08-09, and now it's been referred to as quantitative easing. They've announced and started their third round of this, but what it does is increase reserves at the member banks that they can then lend out. So these are very powerful ways that the Federal Reserve can typically stimulate the economy. Ultimately, though, the Federal Reserve doesn't create anything. It doesn't impact those factors that ultimately lead to GDP growth. What they can do is smooth the business cycle. If we're in a recession, they can typically lower interest rates, stimulate the economy. If things are overheating, if inflation picks up, they can raise interest rates, kind of slow things down. Unfortunately, for long-term purposes, the smoothing of the business cycle is about the best we can expect from the Federal Reserve. And this is typically a very short and medium-term impact. So currently, we're seeing what the limitations of the Federal Reserve actions are. They certainly can help contain inflation by the way they control the money supply, but it's very hard for them to have any sort of direct impact on GDP. What they can do is create, and I think I heard Chairman Bernanke use these words almost exactly, they can create an environment that gives a great chance for things to pick up, but they really can't go out there and start building, start lending, start doing all these things. This is the private sector that needs to do these, and over the long term, President and Congress can enact things that, or policies that have very large impact on these. So a couple items with the Fed. There's been a lot of complaint lately. The Federal Reserve officials are not elected. So that allows them to make quicker decisions. That allows them to focus on the economy versus getting elected, which I think is some of the issues we see in Congress and et cetera. The election cycle seems to last 3 years now. Ultimately, budget decisions have a greater long-term impact on the direction of the economy, but that's not to diminish the role of the Federal Reserve. They obviously have a tremendous impact in the short, medium term, and certainly errors by the Federal Reserve can have long-lasting consequences as well. So in conclusion, and I apologize, I haven't really looked to check to see if we have questions. I don't see any, so I'm going to continue on here, but trying to invest or trade based on the election outcome is a little closer to gambling than investing, and in the current market climate, I simply wouldn't do it. Now, I may revisit this in the next election cycle or one after and see if the social mood and the Dow Jones Industrial Average, I think, is a better representation. We can see the past correlations between the Dow Jones Industrial Average and market returns may not persist. They certainly don't appear to be currently. President, Congress, and the Federal Reserve, they each impact the economy, but in pretty different ways. And that's a topic we could spend a couple hours on, so I'm going to cut it a little bit short, but certainly I'm always interested in talking about this, so if anybody has follow-up questions, we'll make sure you have my phone number if you want to ask. So kind of following up, how can OJM help? And just to go over it again, we do have a multidisciplinary team of experts here. We can assist with tax planning, retirement and insurance planning, asset protection. We assist companies and physician practices with their retirement plans, et cetera. And certainly myself and our other investment professionals are happy to advise on investment income and with an eye towards taxes. Next steps, certainly we'll give you a chance here to select to get a free copy of either for doctors only. We have state-specific books or Wealth Secrets of the Affluent. Let us know if you would like a free initial consult. You can call me directly if you'd prefer, or email me here. But we do have a poll up next, and we'll take a look at that. Well, what's the best way for OJM Group to assist you? Okay. Well, I want to thank everyone for joining us this evening, and please let us know the best way we can assist. My number's here, and again, my email address. I'm happy to take calls, emails, anything, questions you might have, follow-up, or other points. And with that, hope everybody has a great evening, and it'll be interesting to see how the election comes out. Have a great evening.